G'day, Chris. Thanks for joining us for the Fireside chat this month.
Hey Rob, how you going?
Yeah, good. Thanks, mate. Um, so obviously with financial markets, tariffs, tariffs and everything else that's going on, what's your take on what's happening in the markets at the moment?
Yeah, it's a good question, Rob. So I think obviously markets caught a bit unaware by virtue of how the tariffs were announced on April 2nd, Liberation Day, as some call it. And so whilst many expected an extension or an exacerbation of tariffs, I think they were expecting less than obviously that was announced. Surprised a bit in markets in terms of just the magnitude of the rise in tariffs around that date. In knowing Trump 1.0 and obviously Trump 2.0 now, it's fair to say that when he is negotiating, he obviously does negotiate with a wide degree of freedom. So, I mean, higher tariffs were likely, but possibly not as high and as extensive as the market as he had expected. So effectively 70 odd countries got slapped and significantly higher than even the highest expectations by markets. So some countries with 70, 80% tariffs, obviously China, the outlier, was significantly higher in a bit of a tit for tat game. So obviously caught markets unaware. A lot of that wasn't priced into markets. And we always talk about markets being forward looking. So with regard to what markets had to do in a very relatively short period of time was start pricing in some of that risk, I guess, from a macroeconomic outlook, but also from a company earnings perspective, which wasn't featured in pricing. And we saw markets get pretty volatile through the last few weeks as they start to digest some of that. The hard thing with, as we've all noted, the go forward period is the 90-day pause in those tariffs meant the shift in the start date to implementation, which potentially provides room for negotiation in terms of getting negotiations done, but it actually keeps markets in a state of flux for at least the next or the 90 days from that date in terms of certainty or providing certainty around those tariffs. So markets are going to trade off pretty loose information and pretty light information between now and then until we see some headway on some of the tariff negotiations. So interesting period, but fair to say sentiment in markets has been pretty negative through that period.
So just in saying that, I've been watching Scott Bessent pretty closely, and I'm not quite across. Well, I don't think the market's quite across what he's talking about. He's basically talking about the monetary reset. He's talking about the US dollar getting sufficiently weaker because that's part of the US's problem is the strength of the US dollar. And the fact that they've got to export US dollars around the world. The gold price is telling us that that's happening. And to a larger degree, I think bond markets are telling us that too.
Yep.
Is the equity market priced in for what's eventually going to happen? And the way Trump's going, it's going to be sooner rather than later. There will be a monetary reset, which is not a scary thing. It's just it happens all the time where they say the rules that we've been operating under are no longer working. We need to change the format. We need to come up with a new set of rules. And the one thing Bessent's been talking about is we need to get rid of the imbalances that are in the global economy. So is the equity market, given that we've spoken at length that it's actually quite highly valued, is that factoring in, potentially where Bessent wants to take this?
It's not in the short term, I would argue, Rob. So in the short term, it definitely hasn't factored in those sort of risks. The bond market and currency market, like you said, have done a better job of trying to navigate through some of those concerns and some of those issues as you mentioned. And you are right. Trump has appointed some fairly senior, seasoned veterans to sort of certain postings, and so even in discussions we've had with other people, we've sort of been saying, like, you need to listen to these people because they're going to be the architects of a lot of this. So whether you like Scott Bessent or not, it doesn't matter. He's in charge for the next 4 years of the Treasury Secretary portfolio. The guy's pretty worldly in terms of his experience over many, many years. And so has a lot of street cred offshore as well in other markets. So it can be used for a variety of ways. So we've been paying a lot of attention to the words he's been using and the statements he's been making, because I think they're pertinent. But as you said, I don't think that's reflected in equity markets just yet in terms of how they're rationalizing it. If I put my equity market hat on as to why they haven't done that just yet, I think it seems like there's a lot of cash still sitting on the sidelines. Even on days where there's no news, it seems like the equity market wants to go up, which is a little interesting. So it definitely tells you it's not definitely panic stations or fear stations for the equity market just yet. That definitely hasn't played out. But I think if we look forward, if we think about what the US is trying to engineer and change the rules going forward, effectively the big part of it is it's deglobalization. So the world's effectively gone too far on the globalization train is the US pitch, and we need to bring it back. And what does that mean in terms of bringing it back? Well, it means that the US consumer can't do what it did historically, which is effectively borrow to the max and spend to the max. And it also means that corporate earnings can't keep going up the way they have. Profit margins can't keep going up the way they have. So if you work back from that in terms of the US consumer is weakened, profit margins and corporate earnings are weakened, then equities should reflect that, and they haven't just yet. I think the one part they're possibly holding out for is, I mean, Trump's made it pretty clear he wants the economy humming along. So whilst he's up for some short-term pain, I think Besson is as well as part of that restructure. They'll want to get moving pretty quickly on getting the economy motoring out of that. And I think the risk you run as an equity investor is you get very negative in the short term, and then you start motoring out very quickly, and you sort of miss as we come out of this. And I think that's where some equity investors haven't priced this in yet. But we're going to get the truth session during reporting season. So as we get US reporting season coming through, the truth session is going to be there in terms of company reports, and if they're not good, I mean, markets are going to fall again. So we'll see how that plays out over the next couple of months and quarters of reporting seasons.
And I guess, the other thing is, and I've sort of been talking about this in some of the communications to the advisors, is in a world of falling interest rates where we've had a lot of central bank liquidity, we've been taught to buy the dip, and you've been rewarded for that. You haven't been punished. I guess the question becomes, is that strategy still a pertinent strategy, given that, I think the bond market and the gold market are telling us we've actually reached a certain point where investors are no longer willing to just continually fund, without questions, predominantly the US government.
No, I don't think buying the dip is going to work going forward, Rob. I think I'm probably in agreement with you there. I think buying the dip worked over the last 10 or 15 years because what you had is that you had both central banks and governments effectively stepping in the minute something went a little bit wrong. So stepping in very early, like way earlier than they had historically. And so the minute they stepped in, they provided all this liquidity. And so you could buy the dip, which you knew was going to be short. So you got 2, 3, 4 months of market sell down. They came in, washed the market full of liquidity, and away you went. So buying the dip actually worked. The problem this time around is that, as you mentioned earlier, it's a structural change. So there's a structural change up in here. I mean, even the rate relief they're going to provide isn't temporary. It's there to actually fix a structural problem or address a structural problem. So with that structural, change as a backdrop, buying the dip, I don't think will work going forward. Doesn't mean that you can't buy assets on the cheap. There'll be definitely asset prices through the next 6, 12, 18, 24 months that look way too cheap. And there's definitely an element of being able to buy them more cheaply than you could over the last 5 or 10 years. But just buying the market as a whole in terms of buying the dip, I think that strategy's gone for a little while for now anyway.
Yeah, no, I agree. And that's basically why we've got the very active approach at the moment, very specific about where we want to take on risk and where we want to avoid it. The other thing about it is we haven't had a good old fashioned bear market for quite some time. And I guess one of the functions of getting old is whenever you talk to more and more people, you sort of realize that there's a lot of people out there that don't necessarily have the same level of experience as ourselves. But bear markets, by their very nature, can be very cruel. People get used to this concept of crashing, right? We're used to the concept of a crash. Bear markets can basically go down or go nowhere for a long period of time, and it just grounds you into submission. And the old adage is that you're at an end of the bear market when basically everyone agrees that they don't want to own equities, right? So we're obviously a long way away from that. But I guess what I'm just sort of highlighting is we've got to be aware of if the dynamics have changed from what they have been in the immediate past, what potentially could it look like going forward? And going long bonds, going long equities, in my opinion, is not a strategy that's going to necessarily get the best returns for clients over the next few years, which is obviously a lot to do with how we manage portfolios, owning different non-correlated asset classes, and even within those asset classes being selective about where you go, because as I agree with you that there is pockets of really good value out there, but you've got to have the flexibility to go there.
Yep.
So just on that, what I thought we might also do today is talk a little bit about the two different strategies we've got in the MDA on the international income and the international growth. Both obviously reliant on underlying international equities, but the strategies are taking a different tact. So I might just get you to talk a little bit about how they differ, and then we can sort of talk about which investors might suit which strategy.
Yep, cool, Rob. So they are distinctly different strategies in terms of the approach we've taken to them. So with regard to the income strategy, it's ordered as a priority. So what we do there is we prioritize downside protection and income. So they're two overarching factors for the income portfolio. And in contrast to that, the growth portfolio, we're preferencing total return and growth. So they're the sort of two things at play. When you do that on a asset class, and particularly a rather deep asset class like global equities, where you've got lots of different strategies to pick from, you can actually get very distinct portfolios. So quite different, and these are vastly different portfolios. So you'll see, I mean, through the course of 2024, you saw international growth portfolio would have trounced international equity income, and that's distinctly because of the environment we're in. And then you see the last 3-4 months, and international equity income has trounced international growth. And that's because the backdrop has fundamentally changed. And so the portfolios are doing exactly what they're supposed to do in those environments. One's chasing growth and total return on the growth side, and on the income side, we're chasing income and with downside protection properties. So effectively trying to deliver a robust return in the international equity income sleeve, whilst taking on less exposure than the market offers. So what you're likely to see in that portfolio is obviously less passive investments, where the market exposure is effectively one or a beta of one. And strategies that historically have carried significantly lower levels of beta or market exposure, and really good downside protection properties. So we can actually measure that through a lot of these funds' long-term histories, and track how they've performed in down markets, and they've actually performed exceptionally well. So a very different structure. What does that mean? That means in the international equity income portfolio, you're going to see things with a slightly more value bias, slightly more income bias in their approaches. We even have a strategy in there that is solely focused on income. So that is their primary performance objective. It is quite different. And we even have an infrastructure strategy in there delivering excess income as well. So quite a different setup. On the growth side, we've got some passive in there because we want to maintain at least pace with the market in the growth portfolio. But then we've also got some very select investments in there. As you mentioned before, we want to take advantage of some mispricings in market, or give managers a go in that part of the portfolio that have a large degree of flexibility in their approach. So whether it's T Rowe with the ability to allocate to emerging markets, or whether it's GQG with their rotational style, we've got managers in there who are quite flexible. PM Capital's one, obviously, that we've talked about previously, where Paul and team obviously pay little regard to the benchmark or the index. So again, added degrees of flexibility in there, where we're tasking the manager with targeting a total return or gunning for growth. So very different makeups and very different outcomes as a result.
Yeah. So from a client perspective, obviously, if we've got retiree clients who are obviously more focused on getting an income to feed the dog, they don't necessarily want a hell of a lot of volatility, they want to reduce the volatility in their portfolio. Obviously, we tend to probably promote the income type strategies more. But if we've got a 35-year-old, lock and load, it's in the super fund, don't even look at it. Obviously, growth is probably the more appropriate sort of selection there.
That's it.
Now, finally, what I would like to talk about this month is listed property. So what I thought we'd do is we'd just get you to give us a bit of an overview of the listed property space in Australia and what that actually looks like. And then I thought we could just quickly talk about our strategy and how that differs to probably the index as a whole.
Yep, sure, Rob. So the Australian listed property space has been it's gone through a lot of change over the years, and so it used to be a very large sector, then a very small sector, then sort of started to get larger again, but has gone back to being rather small again. and small, not just in terms of the number of stocks, but also in terms of the how big some of the stocks are in the A-REIT sector. And I'm talking about the index here or the broad market. One of the perverse outcomes of our A-REIT sector, even though it's one of the longest standing sectors globally, so if you look at listed property sectors globally, ours is one of the largest and one of the longest standings. They all have slightly different rules in terms of index inclusion. So if you go offshore, things like property developers aren't included in the index, and sort of more niche parts of property aren't included. So it's really a property owners or a rent collectors type index. In Australia, that's not the case with regards to our index. So our index does allow property development and other activities in. So historically, that would have been companies like Lendlease would have been included, Goodman Group more recently, and a range of other companies that had property development as a primary part of their revenue source. So what that's meant in Australia is, as some of these stocks have gotten very large, and obviously if you go back maybe 15, 20 years ago, was Westfields dominating the index. Today, that's less of the thing. But today, as it stands, Goodman Group is 37% of the Australian listed property market. And Centre Group, which is the old Westfields Australia, is another 11%. So those two stocks alone account for almost 50% of the index. And so on any one day when A-REITs are moving, it's pretty much what's happening in either one of those two stocks, predominantly Goodman. And we definitely saw that play out through the last quarter. So if you think of the last quarter, global listed property actually provided some good downside protection qualities, and Australian listed property actually didn't as an index. And that's because Goodman got caught up in the tech sell-off. So Goodman, whilst it's a property stock in Australia, globally it's bought as a data center stock or as a tech stock. So global investors obviously wanted to reduce their tech exposure and sold off Goodman pretty aggressively. So that meant the A-REITs didn't provide the downside protection we saw from other listed property markets. So it is a very interesting and odd dynamic. Take the good with the bad. So whilst that was bad in the last quarter, A-REITs screamed ahead last year, better than G-REITs because of that same effect. So we're seeing a reversal of that, at least in the short term.
Yeah. Now, from our perspective, the listed property strategy that we're running is trying to be more of a rent collection type setup. I think so what we've done with our current exposure is we've sort of got half in a broad, diversified A-REIT exposure through a managed fund, Charter Hall Maxim, and also the MVA. The equal weighted ETF, but then we've got some direct equities in just rent collecting vehicles, where we're trying to get a better yield. Interestingly, the A-REIT sector, the large stocks in the A-REIT sector are around about the 5%, except for Goodman. Goodman's considerably lower. They're around the 5%. And I remember in the good old days, you used to be able to get sevens quite easily. Not so much the case now, but a number of the holdings that we've got are in the 6s and the 7s. And that's because we've gone for the smaller end, pure property plays, collect the rent, move on. So once again, there's good opportunities if you're willing to go outside the index. And that's indeed what we do with our listed strategy. Anything else for this month that you think is relevant, Chris, that we should be raising?
No, I think the opening statements and comments sort of speak to what's playing out in terms of the market backdrop, and I think we've touched on two key areas of our portfolio which have held up relatively well in the last sort of at least 3-4 months, and both of those parts of our portfolio might have been with a question mark against them in 23 or 24, and that really strong growth momentum environment. But I mean, testament to and a good proof point around how we've got them structured. Obviously performed quite well in the last 3-4 months in terms of providing that strong downside protection in adverse market environments. So I think they're two very critical parts of the portfolio for us to talk to.
Excellent. All right, mate. Well, mate, thanks for joining us, and we'll talk next month.
No worries. Thanks, Rob.